Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. The EU willing to accept a trade arrangement with the United States that includes a 10% universal tariff on many of the bloc's exports, but continues to push for quotas and exemptions across key sectors. And on Capitol Hill, Donald Trump's $3.3 trillion tax and spending bill faces roadblocks as Senate Republican leaders continue to scrounge for votes. Meanwhile, right here in the UK, Prime Minister Keir Starmer braces for what could be the most consequential vote of his premiership, and that is as his government's welfare overhaul faces a major challenge from members of his own party. We'll debate the implications for the gilt market. Guy.
It is a new quarter, but the markets aren't doing anything. What is the catalyst going to be that's going to get us moving again? This is the picture this morning. We don't see anything, but there are plenty of things on the agenda. Kriti's just run through some of the details. There are plenty of things that we need to be worrying about right now, plus all the US data that is coming towards us as well. Stocks 50, no change. S&P futures, no change. Euro dollar, absolutely no change. Gold is a little bit bid this morning. The countdown to the opening trade starts right now. Tuesday morning, nothing has changed. Exactly the same agenda that we basically had yesterday. We're wondering what's going to happen with the tariff agenda. We're wondering what's going to happen in the Senate today. When are we going to get the big, beautiful bill? And what is going to happen with Keir Starmer? Basically the same agenda that we had yesterday, but today it is even closer, and we count down to a number of different deadlines that we are facing today and over the next few days, Kriti. Let's start off with the tariff story and where we are with that this morning. It looks like the EU's prepared to accept 10%, but it wants key carve-outs, particularly in the area of autos. The Japanese want the same thing. Is the Trump administration minded to give anything on this area?
Well, how are we supposed to interpret this? Is this a sea change from the EU? Does the 10% really even matter if you get the carve-outs on things like autos? Pharmaceuticals were thrown in there as well. Of course, the commercial aircraft story continues to be one in terms of the Boeing Airbus divisions. I think it's fascinating because in this last 24 hours, you've seen a real turnaround in terms of the potential effectiveness of Donald Trump's policy. I think you covered this on the show yesterday when it comes to Canada and the digital tax kind of services and requirements and response there as well. To me, I think what stuck out of this whole thing is actually a quote from Torsten Slok over at Apollo. He's the chief economist there. He's someone who's been very vocal about the recessionary fears and kind of catapulting the U.S. economy into that. Well, in June 21st, this is something that's starting to make the rounds in terms of right-wing media in the States. He actually said a blog post, and I'm not sure if this was comical or not from his perspective, but he was simply saying that maybe Donald Trump outsmarted us all. It would be a victory, producing $400 billion of annual revenue if everyone else, trade partners included, would be happy with the 10% tariffs. Meanwhile, U.S. tax revenue just goes up. Maybe Donald Trump outsmarted everyone. I think it's a fascinating one because although maybe he is saying it comically, maybe that is his view, at the end of the day, it's something that a lot of people are actually asking in the last 48 hours whether this policy actually works.
Okay. Do you think so?
Not my place to say. I'm saying it's out there.
It is out there. I don't know. Maybe the UK deal was setting the agenda. Maybe that's where we ultimately are going to land for many of these trade deals. But you have to wonder whether or not the carve-outs, if they don't become forthcoming, whether or not we're going to end up with a significant problem here. And the U.S. administration is promising these deals are going to get done, maybe not by the 9th, but they are going to get ultimately done. The Germans clearly want an auto carve-out. If they don't get it, are we going to get a deal? And if we don't get a deal, how bad could it get and how quickly could it get bad, I think is the question. Let's talk about what's happening in the Senate right now. You check the live feed, go to the live feed, check it out, see what's happening there. There are still warm bodies on the Senate floor at this early hour over in the United States as we continue to watch the progress of the big, beautiful bill, or the lack of it. Basically, they have one senator that they need to persuade to get this over the line. The problem is that we are in a situation where ultimately, after Rand Paul and Tom Tillis backed out of backing the bill, we are on a knife edge. And the interesting thing this morning is that this is turning into a debate between Elon Musk and Donald Trump. And I think that's the new element this morning that we need to pay attention to. Basically, if you are a senator that votes against this, you are going to face the ire of Donald Trump. If you are a senator that votes for this, you are going to face the ire of Elon Musk. And Elon Musk has an awful lot of money. And you've just seen the broadside that Trump has fired at Elon Musk this morning. Go back home if you don't like it here, basically, is the message. Musk is talking about starting a new party. This debate is just getting going. And I suspect that actually this is going to become even bigger than the big, beautiful bill.
This has real market implications, not just in terms of what the tax policy ends up being at the end of the day via this, or whether the bill actually happens. But at the end of the day, there is a question here about just how much of Elon Musk's businesses, we're talking about Tesla, SpaceX, among many, many others, actually depend on those government contracts. And by the way, the S&P 500 very much exposed to a lot of them. Tesla is, of course, the main one.
Absolutely. So this is a fight that is brewing. It's been brewing for a while. Are we about to see the spark that really kind of means that it bursts into flames? And what are the implications of it bursting into flames? We've got a bit of time here, so I don't think we should get too over our skis in terms of our concerns. So the debt ceiling, we don't really hit that until August. We've got time to get this all done. But nevertheless, Trump has set an agenda for this Friday. Yeah. A deadline for this Friday. And if we don't get there, kind of, you start wondering whether the whole process begins to fracture even more. Like there's this unifying kind of, we must be here by then. If we're not, you wonder what happens after that.
In the meantime, Tesla shares falling almost 6% on TradeGate relative to Monday's close. That's going to be something to watch in the pre-market there as well. So we talked about the international tariff agenda. We talked about the domestic United States kind of political agenda there as well. Let's talk about something that's also very much a political story here in Europe. And that, of course, is going to be the banking story. We talked a lot about banking consolidation. This was a key part of our interviews last week as well. Now it looks like BBVA, Sabadell, which we're kind of using as our poster child for the banking consolidation story across Europe, they have or BBVA at least, has said they are moving forward with the deal, despite some major pushback from the government. They've imposed some enormous conditions in terms of not only the takeover, but the fact that you have to keep these two entities separate for as much as 5 years' time. BBVA saying, look, the synergies are still there, just slower to get there, but still there. I think the main takeaway of this is less what's going on in Spain, but more about what kind of precedent it sets for banking consolidation across Europe.
This is a really bad sign for the Spanish government. If you're BBVA, what are you saying by doing this? You're saying that you don't believe that the Spanish government is going to be around for very long. That's what they're signaling here. They're signaling basically that you get a new Spanish government, maybe you don't have the same political constraints being put on the deal as you currently have.
Well, they're also dealing with another issue, which is that BBVA, again, very similar to the kind of Spanish political stories, also dealing with the Spanish pressure when it comes to the fact that most of their exposure comes from abroad and not from Spain. So that's another piece that they're trying to address. And that was arguably one of the early motivators of actually pursuing the Sabadell deal.
So they pursue it. They can't really get it done. They wait. They hope that some of the constraints ultimately go away. That's what they're looking at further down the road. Let's talk about where we are this morning and some of the debates that we're going to have around the table this morning. Mark Dowding, RBC Blue Bay Asset Management CIO for Fixed Income, is going to be joining us. Need to talk about the story in the States. We also need to talk very much about what is happening here in the UK. Marina Zavalok, Morgan Stanley's Chief European Equity Strategist, is going to be joining us as well. Has the European story run out of road? Does it continue? Is FOMO the big story over in the States, and how do we fold the dollar into the narrative? Freya Beamish, TS Lombard's chief economist, is going to be joining us a little later in the programme as well. An excellent lineup. Plus, we're going to bring you some great guests from Sintra.
A fascinating one, perhaps talking about where the European economy is headed. We're about 24 hours out from Christine Lagarde revealing the new strategy over at the ECB. Plenty of data as well to keep an eye on. At 10 a.m. UK time, that Euro area CPI is going to be hitting the wire. 2:30 p.m. UK time. The ECB forum, as Guy mentioned, plenty going on out of Sintra. We do have a panel coming up there. I believe Francine is leading it with the ECB, Fed, BOE, and BOJ on it. Four very different central banks on four very different paths when it comes to the rate story. 3 p.m. UK time, U.S. ISM manufacturing, and of course, at the same time, we get those U.S. JOLTS numbers. So plenty of data in the sea of interviews.
Absolutely. What else do you need to know? This was it Tuesday morning. Bloomberg has learned that Apple is considering using outside AI to power a new version of Siri. Sources say the company has talked with both Anthropic and OpenAI, asking them to train versions of their models for testing. If the plan moves forward, it would represent a significant reversal and an acknowledgement that the company is struggling to compete in generative AI. Boeing says its CFO, Brian West, is to step down. Well, West helped orchestrate one of the biggest capital raises in U.S. history last year to steady the plane maker. He will leave in August to be replaced by a former Lockheed Martin executive CFO, Jay Malev. And the UK Prime Minister Keir Starmer, who marks a year in office this week, I think it's on the 4th, is facing a crucial vote on welfare spending reform. Starmer spent Monday trying to persuade sceptics in his own party to back a revised package of reforms to disability benefits, but Labour rebels are warning the government's plans still risk defeat. A loss would deal a major blow to the government's authority and could lead to doubts about the Chancellor's fiscal plans. Let's talk about this in a bit more detail. We're going to do it a little bit more later on in the programme. But basically, the long of the short is, it's another major climb down already from Starmer. That's the position we find ourselves in. He's already backtracked significantly, but he may face a significant rebellion today. Basically, it signals 1 year into office that Starmer is struggling. He's got an awful long way to go, but he's basically, him and Rachel Reeves have set themselves up for failure, it looks like, this morning. And that is the problem that we find ourselves with here in the UK, and the gilt market is beginning to start to pay attention to this. Basically, there was an idea that we are not going to raise taxes on working people, and we are going to stick to the fiscal rules, i.e. we're not going to borrow more. The sums don't add up, and today we're going to see another example of that. There is a leftist-leading government that is increasingly sort of incoming.
Yeah.
We've seen a sort of non-committal government up until now, but it looks like we are going to face a more leftward-leaning government, and that's going to be a real problem for the gilt market potentially going forward from here.
I wonder if it's something that gets priced in about 50 minutes' time, 48 minutes' time, if you will. There's plenty of there to digest as well. We're going to have that conversation with Mark Dowding shortly. Coming up on the program, as Europe seeks to boost defense spending, we're going to speak to the CEO of Renk, one of the German companies set to play a key role in the push to rearm. Plus, as we discussed live in Sintra this morning for the ECB Forum on Central Banking, we're going to bring you an interview with ECB Vice President Luis de Guindos shortly. But up next, we are right back in Sintra. Joachim Nagel, the president of the Bundesbank, joining the program with our very own Francine Lacqua on the ground. If you have any questions of our own for our guests or for us, dive into the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
OK, we're about 45 minutes away from the equity market session, and as you can see on the screen in front of you, equity markets aren't exactly on fire this morning. We are going nowhere in a hurry. It may be the start of a new quarter, but we don't have a catalyst yet. Where does that catalyst come from? Well, maybe from the central bank story. Let's head, therefore, to the European Central Bank's annual forum, which is taking place in Portugal, Sintra, Portugal. I probably want to get that the right way around. Bloomberg's Francine Lacqua is at the event. Francine, over to you.
Well, we'll take both. Portugal, Sintra, Portugal. Guy, thank you so much. Joining us now is Joachim Nagel. He's president of the German Bundesbank and, of course, ECB Governing Council member. President Nagel, thank you for joining us. I mean, there's a lot going on inflation, growth expectations, and everything like that. But do you think the ECB is done cutting rates now?
Good morning. I believe that at the current situation, that maybe to put it like this, that we are in calm waters. That doesn't mean that we shouldn't be too complacent, but we are at our target, and this is really good news. I think when you look back where we started and we hiked 10 times, we lowered 8 times, now we are close to our target, and this is good news. But as I said, complacency is not the way we should see it. I think we are now coming to the summer break. This is also good news. And then we have to think about what does that mean for us when we have the new projections in September. Over the last couple of weeks, we saw a lot of volatility in the energy market. So energy prices went up, came down again. So I guess it is a good, this is a good indication that we have to be cautious.
Mr. Nagel, how high is the bar actually for another move in autumn, though?
Well, I do not define a certain bar. I make it dependent on the new data. I think this meeting-to-meeting approach seems to be, from an outside perspective, maybe a boring approach, but I think it's a very, let me say, relevant way to do it because of this uncertainty. We have to be prepared for everything. So I will see what the data will tell me in autumn, and then we will see.
But if there is a cut, it would be stimulative. Is that the way to see it? Because we're more or less at neutral now?
I believe we are in the neutral territory. You have different calculations where the famous R star is a little bit higher than 2%, a little bit lower. But we are in neutral territory. coming back to what I said, I think this is good news. And so we can have this kind of wait-and-see attitude. Yeah.
But I mean, for it to go into stimulative territory, would growth have to take a hit?
I think many things have to come together to do what is necessary the next time. And as I said, I will not speculate which direction we are going, but I believe now we are rather comfortable with 2%, so we can check what will come over the next couple of weeks, and then we will take a decision.
Mr. Nagel, the weak inflation outlook is of course helped by euro, but also oil prices. How volatile are these?
I guess after the events at the beginning of April, where we had this high volatility around US treasuries, and then the geopolitical risks, everything that came together over the last couple of weeks, they drove energy prices up, down, and now we are in a much better situation compared to a couple of weeks ago because the tensions in the Middle East came down a little bit. But I learned this lesson over the last 6-7 months. You have to prepare it on a daily basis, checking the news every morning, and then we'll see.
Hopefully Bloomberg.
Yeah, for sure Bloomberg.
President Nagel, I mean, how worried are you about actually the euro appreciating against the dollar?
I think if you take the price of the euro against the dollar over a long period, then you come to the conclusion that the current price level is close to the mean over a long period. So it's not exceptional high. It's to me, it's not such an issue. But as a central banker, we have to look at it.
So it wouldn't, but it's not one of the things that would tilt the balance towards more cuts?
No, I think we are not too much focused on the exchange rate. So we have to be focused on the price level. Yes, there are some spillovers coming from the exchange rate, but it's only one factor. So we are taking into account all the factors that are leading to higher or to lower inflation. And this is the relevant way we should see it.
The European economy actually did, pretty well in the first half or in the last quarter. Is that because of trade front-loading?
I think, this might be the case that trade front-loading is here the most important factor that gave us these good numbers for the first quarter. Now we have to take into account what comes from the tariff side, how this is evolving over time. And the point that I have here, we need, let me say, decision. We need more stability. We have to reduce uncertainty. And so I really hope that this tariff discussion is coming to an end, to a good end.
To a good end. How do you see it playing out? And again, because of front loading, could you see it then fall off a cliff, or is it gradual, or is it just very difficult to model it?
If you want to bring yourself into the shoes of somebody who's doing an investment in a very uncertain world, when you think about the tariff discussion, I think for those we have to give clarity. We have to give them an orientation point where the tariffs are going. So I'm not putting like this that we are falling off a cliff, but financial markets, they need certainty. If there is uncertainty, then we see high volatilities. And so I guess it has to be of utmost importance to bring this whole discussion to an end, to a good end.
But given the uncertainty surrounding trade, could it still change the economic outlook for Europe?
Yeah, absolutely. It can change the economic outlook. I think if the tariffs are coming out at a very high level, I think this will be a burden on the economy. This is absolutely clear. And this is in a situation where you already alluded to that the economy in Europe is picking up. Taking my own country with the fiscal package, I think this year it looks around a little bit above zero growth, and then the next year we will see we'll see 0.6, 0.7, and then in 2027, maybe then it's maybe here 1.2 or something. So what I would like to say with this, that we are in a fragile situation, and when there is this, let me say, situation where we have this uncertainty, and you are in a fragile situation, this is a burden to the economy.
I mean, given all of this uncertainty, is that why it makes sense to have scenario planning, so that it's a lot more nuanced when you look at the risks going forward?
I think this is part of our new strategy review, that we are doing this scenario analysis. We did it in the past. Now we're doing it a little bit more, let me say, more intense, because we take into that now we are checking all the different all the different possibilities. And so I believe this is an important exercise, and this review was important to do because we came from a situation where inflation was way low. Then after the pandemic and this Russian war of aggression against Ukraine, we came into a situation where inflation was much too high. Now we know a little bit better how the instruments are working, and we realize that we have a rich tool that we have here available to tackle all the different situations.
But is there a danger that it helps with I guess, market expectations, but it's a little bit confusing for citizens?
I'm not sure it is so confusing for citizens. I think it's the matter, or maybe it could not be as confusing as you think when the communication is right. And I didn't have the feeling that inflation was disentangled from our view, what we think about monetary policy. The people understood what we did. There was this understanding we had to do something when inflation was much too high. Now there's a good understanding that we could lower interest rate by 8 times. I believe it's about us. It's about us central banks to do the right communication.
Given all of the uncertainty about the dollar and question marks about it being a reserve currency, do you see the euro playing a much bigger role, like Christine Lagarde has suggested?
Again, it's dependent on us. It's dependent on the Europeans. I guess we have to lower the barriers. I think we have to remove obstacles. So the capital market union or the savings and investment union is one of the most important topics here. The banking union on top of it. So we have to make the euro more attractive for international investors, but it is a window of opportunity. It is about diversification. Coming back to the April episode, I think this was a good lessons learned. So I believe now it is on us, the Europeans, to do what is necessary to make the euro much more attractive. But I believe in the future, the euro will become more relevant.
But you're confident that actually there are the right that there are the right steps that policymakers will try and make it happen.
I'm always confident, but what I see on the Commission side, the competitive compass, I think this is the right direction. So I have the expectation that the Commission, that Europe will deliver on all what I mentioned: capital market union, banking union, and if this is coming over the next couple of years, then I believe that many investors will take this will take this decision to have maybe a better diversified portfolio. But nevertheless, I will mention this: the US dollar is important for all of us. I think it is not something we should take as granted, that the dollar is not having a position that the dollar had over the past, because it is important to us that the dollar is giving us a stable environment. But a stable environment could also come with a more relevant euro.
Joachim Nagel, thank you so much for your time today. That was, of course, the Bundesbank president and ECB governing council member. Back to you in London, Kriti, and we'll have plenty more from Sintra, Portugal throughout the day.
Absolutely. Francine Lacqua there, as she was saying, speaking to the Bundesbank governor. And a reminder, as Francine said, at 2:30 p.m. London time, Francine is hosting a policy panel with the world's top central bankers. You got the ECB, the BOE, the Fed, and the BOJ all represented. We'll have that live right here on Bloomberg Television. Terminal users can get commentary and analysis from that forum. TLIV Go is the function on your terminal.
OK, what have we got coming up for you? The UK Prime Minister, Keir Starmer, facing a revolt over welfare reforms. We are going to discuss the details. Mark Dowding from RBC Blue Bay Asset Management will be joining us very, very shortly. Is the gilt market going to start to pay attention to this story? We'll find out in just a moment. This is Bloomberg.
Thirty minutes away from the start of the opening trade, futures aren't doing a whole lot. Some marginal outperformance over in the French index, but the rest seems to be a very quiet start to the first day of the second half of the year.
Absolutely. The last quarter, though, has been amazing in terms of the turbulence that we have seen. So we're wondering whether or not that is going to pick up at some point. There are plenty of catalysts out there. The bond market, let's just take a quick check and see what we're seeing there. early stages of the process this morning, but as you can see, a reasonably becalmed bond market as well. But as I say, there's plenty of catalysts coming from the other side of the Atlantic and from this side of the Atlantic this morning. Let's start off on this side of the Atlantic. The UK Prime Minister Keir Starmer is working to contain a rebellion in his own Labour Party ahead of a critical vote today on his flagship welfare policy. The bill has provoked widespread internal criticism and cast doubts over Starmer's leadership. Remember, we are coming up on the one-year anniversary. I think it's the 4th. That is later on this week, Friday. We're joined now by our London Bureau Chief, Ruth David, and Mark Dowding, the CIO for fixed income at RBC Blue Bay Asset Management. Ruth, what do we know? We're nearly there. The vote has to happen fairly soon. We're going to get it maybe later on today. What do we know about the arithmetic?
So as of last night, our reporting was showing that there are rebels who are saying the chances of this vote going through are still not 100%. And if Prime Minister Starmer doesn't manage to get this through, I mean, this is, of course, the most consequential challenge to his leadership that we have seen yet. But there hasn't been a sitting Prime Minister that has seen a bill fail at this level since 1986. So the ramifications of that could be seismic. And then, of course, you have to look at what does this mean for Rachel Reeves. You know, Labour came into government and they said, we're not going to raise taxes and we're not going to increase borrowing. But then everything else that they're doing has been met by stiff opposition. I mean, we saw them change some of the terms on the personal independence payments last week at a cost of $3 billion to the Treasury, right? We know how the non-doms and inheritance tax move is going. So this is not looking good on, as you said, the first year anniversary of this government.
Things could go very poorly very quickly is what I'm hearing, Ruth. Mark, dive into this conversation with us here. How should the market be thinking about this?
Well, I think the market is right to be concerned. I mean, the truth of the matter here is that what we're seeing in the UK is evidence of fiscal slippage. Obviously, Labour had to find more money for defence in order to honour the NATO commitments last week, didn't they? And here, the concessions that are being made to the Labour rebels, to others within the party, I think all of this is challenging the fiscal maths and the way that we're moving, unless we're moving towards tax cuts or tax hikes, I should be saying, later in the year. Then the OBR framework is going to be challenged. And I think this is going to be a source of concern for gilt investors, most certainly.
So to gilt at the moment, it looks like to me that the gilt market hasn't woken up and paid a great deal of attention to this story, or is just waiting and watching. If the vote fails today, does that change?
Look, I think that could be a certain catalyst, yes. I mean, in the course of the past couple of weeks, gilts have been helped out by the fact that Treasury yields have been moving lower, partly because Trump is trying to weigh in and try and pressure down sort of short-term interest rates. And so gilts have benefited on the back of this. But I would say under the surface, gilts are remaining vulnerable. And if we do see a situation where it's writ loud and clear that fiscal slippage is back here and Labour can't be trusted with the government's finances, then I think we've got a problem on our hands, potentially.
Fiscal slippage. That doesn't sound good.
Can we get that on like a T-shirt, a hat, and make that part of this show's memorabilia? Ruth, what's the best case scenario here? How does Keir Starmer navigate a win out of this?
The best case scenario is the bill passes, right? He gets enough Labour MPs to vote on it. And then from there, he takes one step forward. I mean, they had reasonably okay numbers on GDP come in yesterday. And Rachel Reeves has been hoping the economy will rescue them, which we haven't seen so much of yet. But I think if Starmer gets this one win, things are looking slightly better for him. But also keep in mind, we had fantastic reporting over the weekend that said Starmer's position, Rachel Reeves is seeing a lot of opposition to her. Yeah. And this is a government that has made progress on certain things, right? We're talking about knife crime is down. They've got a lot of big infrastructure projects. When you speak to tech company CEOs, they say that the government is trying to engage with them. But in the rhetoric around everything else that's going on, that message isn't coming through. And the fact that Nigel Farage's party, and last week we had this YouGov poll that was showing if they were in election today, they would probably have the most number of seats in the House of Commons.
But there won't be an election for another 4 years.
Yes.
And this is the point here, is that they've still got an awful long way to go with this government. We're 1 year in. Things aren't going quite as well. They're not getting maybe some of the credit for some of the things that you're talking about, but they've still got an awful long way to go. Mark, how much legacy is there in the gilt market from the Liz Truss incident? You talk about the gilt market being kind of fairly fragile at the moment. Has it ever really recovered from that? And are we in a situation where actually it wouldn't take that much to knock it off course at this point?
Well, I think that when you have a situation like we saw with the Truss government back in 22, then effectively that's going to put on a premium that's is quick to go on but hard to get rid of. And at a time where globally everywhere there's concerns around rising debt levels, not just in the UK but bluntly everywhere, I think the problem that the UK faces potentially is that it could be seen as a bit of a canary in the coal mine. It's had a blow up before, it's had a tantrum before, so it's potentially vulnerable to another tantrum again, isn't it?
Go.
Oh, I was going to say, well, talk to us a little bit about the read-through in terms of the currency impact here a little bit. We keep talking about the gilt market in terms of moving off of this potential or even the fiscal slippage as you talk about it. What about the currency? Why is the currency not reacting in the same way?
So I think the pound has obviously been sort of doing well against the dollar, but from that perspective, we've obviously sort of seen that being driven by the weaker dollar environment that we're in. If you look at the pound against the euro, it's tracking sideways. It hasn't been in the spotlight at this particular moment. But I would suggest that if we did see a situation where you were looking at a gilt market tantrum once again, then the pound could be on the back foot.
Can I just widen the lens a little bit and talk about your views of what's happening over in the United States? Trump wants rates to come lower, sharply lower. You've got a spending bill that is struggling in similar ways, you could argue, to what we're seeing here in the UK. Politics is interceding in a way that is deeply concerning, I would say, maybe for the Treasury market going forward from here. But we're not quite there yet. What is your assessment? Is there a danger that the Treasury market grows seriously concerned, that the long end has a moment in the same way that we've seen in the gilt market here because of the fiscal spending that we are talking about stateside? Yeah.
So look, I think the situation in the US is that we haven't had a tantrum in the bond market in the same way that we've had one in the UK to sort of discipline investors. And so from that point of view, I'd actually say the administration remains relatively complacent around bond market risks. And I think the thing to really remember is that for the time being, cutting taxes, raising spending, this is politically popular. This is what's winning votes in the United States. And so I don't think that President Trump or this administration is going to be changing course in terms of the fiscal plans until markets effectively discipline the government into doing so. So for the time being, we're running 7% deficits. We carry on running 7% deficits. At some point, I do think that bond markets will bite back against that. But trying to say when the bond vigilantes have their day, who knows? It could be this year or maybe next. But then again, you can get complacent, just like Man City did last night, and you can end up
I was wondering where you were going to go with that.
Losing to a bunch of Saudis, right?
I was wondering whether that was going to come up. Ruth, talk us through the timing. So we're watching what is happening quite carefully in Washington today. Just walk us through how today is going to work, what we need to watch out for in terms of the useful indicators that are going to tell us whether or not actually Starmer's going to get this one over the line.
So, well, this one we are waiting till this afternoon for the vote, and they have to say at some time. So maybe this evening we'll get a statement on it. And until then, there's probably going to be some leaks, I imagine, to the media. I mean, the papers have been talking since the morning and since the last week, right? Who is voting for, who is voting against, how much Starmer has managed to quell the rebellion. So that's probably going to be the 24-hour news ticker going on for the day.
And just in terms of the shock that will come if he loses this.
Oh, absolutely. Absolutely. And then I think the voices that have been speaking anonymously behind the scenes saying, well, you know, as a leader, you've made these U-turns, because this is his third U-turn, remember. I mean, there was on the grooming gangs, there was on the winter fuels payment, there was him retracting what he said in that speech where he spoke about immigration, right? And that was seen as populist. So I think you have a leader that is dealing with the left wing of his party and unable to get some of the big moves through that they are planning, but also facing the threat of reform and voters going that way. So Starmer is on the first-year anniversary in a really tough position. I mean, this vote going through doesn't mean it's all going to be easy for him then, right? There's still plenty of other challenges. And then what does Rachel Reeves do in her budget? Where does she get the money from if they keep cutting back on all the schemes that were going to raise the money for the Treasury?
Yeah.
That's a fascinating one. It's the very case, basically, that undermines so much of the European bull case right now, that so much of the defense spending, et cetera, gets rerouted to other things like those welfare stories. We'll see how that all turns out. Mark Dowding, CIO for Fixed Income over at RBC Blue Bay Asset Management, and our very own London Bureau Chief, Ruth David, joining us around the table ahead of that crucial vote this evening. Coming up, we are heading right back to Sintra to speak to another ECB Governing Council member, this time Luis de Guindos, joining Bloomberg's Francine Lacqua on the ground in Portugal next. Stick with us. This is Bloomberg.
Welcome back. 15 minutes to go until the market open. At the moment, we're looking at a picture of you. We are going to be talking about what is happening in these markets in just a moment. Let's talk about what is happening in Sintra, Portugal. Francine Lacqua standing by.
Thank you so much. I am delighted to be joined by the Vice President, of course, of the ECB, and he is Mr. de Guindos. Thank you for joining us. There's a lot going on, Mr. de Guindos. We talk about trade, we talk about inflation, we talk about growth. When you look at trade negotiations right now, could they actually change the outcome of the European economy?
Well, I think that is going to be a very relevant factor, no? And if you see, for instance, if you watch our projections, there are different alternatives, different scenarios according to the different outcomes that we might have, no? I hope that, the negotiations will be finalized. So at least this, will deliver a little bit of predictability, because now, the level of uncertainty is huge. And I hope that the negotiations will be positive for everyone, no? But, the case for higher tariffs is quite clear, no? So this is something that we will have to deal with.
Vice President, given where we are now, do you think the ECB is done cutting interest rates?
Well, what I think is that, we have reduced interest rates 8 times, and that now, from 4% to 2%. And I think that, as the President Lagarde indicated, we are in a good place, no, to deal with the future. But the level of uncertainty is huge, It's becoming a cliché. But I think that we have to be open and to maintain all the options open for the future. Because, for instance, after the publication of our projections, we had the conflict between Israel and Iran that implied an additional level of uncertainty. So this is the situation. Geopolitical risks. We do not know what's going to be the final outcome and the final result of the trade negotiations. So this is something that we will have to deal with in the near future.
But Vice President, how high is the bar actually to do another cut, given that you'd have to think, I guess, more holistically about going into stimulative territory?
Well, here, the approach is quite clear. I think that now, we are in a good place, as I have said before. I think that, the evolution of inflation is going to be positive. I think that we are very close to our target. I think that, the possibility of undershooting is not big. It's quite limited. And, let's see, But, for instance, I don't know, geopolitical risks are going to be there. And this is a factor that we have to bear in mind. So we are open-minded with respect to the future. But we are, positive with respect to the evolution of inflation. And we believe that we are going to be able to reach the level of price stability that we have defined.
But if interest rates go below 2%, it would be the economy would have to be quite bad.
Well, the economy is not good. This is something that we have indicated. The growth rate in the euro area is going to be below 1% in 2025 and, a little bit above that, in 2026. I think that the risks are clearly tilted to the downside. I think that the level of uncertainty, is having a dent in the evolution of the economy. We see that investment is flat, even consumption is not recovering. I think that the first quarter of the year was a little bit, a sort of an illusion, in the sense that 0.6 was a, distorted figure. We believe that the second and the third quarter, the growth rates are going to be much closer to zero. So that's, the situation, but, an additional cut of interest rates is not going to help the economy to improve.
Right.
So, I think that what we need is certainty about trade policies, tariffs, fiscal policy. That's the kind of reform that we need in Europe in order to try to foster growth.
Does that feel quite unlikely at the moment, given all of the global uncertainty? So you can do things in Europe, but actually we don't know how everyone else behaves.
Well, that's right. But I repeat again, I think that, Europe is at the crossroads in the sense that we have a clear opportunity. I think that the future is in our hands. If we start, to put in place and to pursue the correct policies, I think that, Europe can start to recover. There is a unique opportunity now.
How much do you worry about the euro being actually volatile? So it's helped with inflation. But does it become too high against the dollar?
Well, now it's 117, as you know. No, I think that is, I think that, the level is not the problem. I think that this is perfectly, acceptable according to our projections. Here the question is, that we should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, is not something that we cannot. We can overlook a little bit. Something beyond that, it will be much more complicated. But 120, I think that is perfectly acceptable.
So if there is a little bit of an overshoot, and as you say, it becomes a little bit more complicated, does it tilt then the ECB towards more cutting?
No, well, we do not target, the exchange rate. We take into consideration, the level of the exchange rate and the evolution of the exchange rate. And we incorporate, the level of exchange rate to our projections. No, so a more appreciated euro is positive for, the evolution of inflation, as you know, and this is something that we are monitoring, that we are looking at, but we do not target any concrete level of exchange rate.
Of course,
euro,
yeah. But Vice President, I mean, when you look at the inflation rate, how confident are you that it goes, to 2% and not to 1.6%?
Well, we are confident, undershooting is not, our baseline at all. I think that, there are two factors that are, favorable to reduce further inflation. The first one is the exchange rate, as we have mentioned, and the second one is the evolution of energy prices. And I think that, in the first quarter of next year, it will be clearly below 2%, but afterwards we have projected a recovery of the inflation rate toward the 2%. So, the possibility of undershooting is something that is not, the baseline in our projections at all.
Does the defense spending, the 5% of GDP from most countries, actually help also with inflation, but also growth?
Well, it will depend, on defense, the kind of defense spending that, the different countries are going to implement and to pursue. What I can tell you is that, there are different multipliers according to because, defense spending is not, is a mixed bag. You have different kinds of expenditures there. But, I think that I am a little bit more worried about fiscal policy. I think that fiscal policy, I think that the need of, increasing defense spending is something that is quite clear. I understand perfectly why, and I think that we can support that. But, simultaneously, we have, to send a very clear message that fiscal sustainability is needed. Because markets now, they are not paying much attention to fiscal policy, even in the case of the US, and we have to take into consideration the different legislation that is going to be passed there. But, that can change. You cannot take for granted that markets are going to ignore and overlook what's happening with fiscal policy.
Do you worry about a market event linked actually to something
here,
that's
if
happening to the
markets
US?
start, to perceive that fiscal policy is not sustainable over time, yields will go up. And, this will have, an impact on valuations, because valuations are very elevated now. And, this is something that we have to bear in mind and, to monitor. Here in Europe, the situation is a little bit different. The level of yields, is below the level in the US. And, the markets, sovereign markets are very, very, very quiet and very calm. For instance, even spreads have been narrowing. But we have to continue guaranteeing markets that fiscal sustainability is going to be in place.
Okay, thank you so much for joining us, Mr. Guindos, there with the very latest on, of course, some of the ECB policy. With that, Guy, I'm going to send it back to you in London. We'll have plenty more from Sintra here in Portugal.
Francine, great interview. Thank you very much indeed. Francine Lacroix at the ECB event in Sintra. We will continue to follow all of the twists and turns in terms of the debate in Sintra. And believe you me, there's going to be some twists and turns coming up a little bit later on. 2:30 p.m. London time. Francine is going to be hosting a policy panel with the world's top central bankers. We are going to be covering that. You're going to have the big names. The major players in global central banking will all be on stage at the same time, and Francine is going to be moderating that. You can follow it, TLIV Go. You could probably watch it as well. You probably want to watch it to make sure you are up to speed with exactly what the thoughts are. It's going to be interesting.
It's going to be a fascinating one. I'm looking forward to seeing how all of those central bankers with very different rate paths maybe form some sort of consensus. So I imagine the word uncertainty will come up quite a bit, the usual Fed speak. In the meantime, we're about 5 minutes away from the opening trade, seeing futures literally unchanged when it comes to Euro Stoxx 50, some slight outperformance when it comes to the French index. We're going to dive into those details, but I think the more exciting piece maybe for you, Guy, will be the gilt market open, also happening in about 5 minutes.
Absolutely.
Time.
I'm not sure. I think it could be tomorrow's gilt market open that could be fascinating. Anyway, 5 minutes to go. The open is coming. This is Bloomberg. Tuesday morning, we're waiting. We're waiting for another catalyst. Yes, we're starting a new quarter. Yes, we're starting a new month. But we need something new to get this market going again. This morning, it looks like futures are becalmed. We'll show you the numbers in just a second. This was the legacy coming out of yesterday's session. Europe fades into the close. The US picks up towards the end of the session. But actually, net, there's not actually a lot to take us further forward here. There's a few single stocks that we're going to be paying attention to. Keep an eye on what is happening between Donald Trump and Elon Musk as well. That's going to be a story, I suspect, for later on in the session. But this morning, we don't have a lot going on. I'm going to show you exactly what that looks like right now in terms of the futures picture. Let's show you the picture. It is a becalmed one. It's going to move on. There you go. Euro Stoxx 50 futures, no change. FTSE futures, no change. DAX futures, no change. In fact, FTSE futures move to unch right now. The gilt market, the bond markets around Europe largely becalmed as well. But we've got plenty of catalysts. Key votes are coming up in the UK and over in the United States. We are watching both very, very carefully. Plus, trade progress. Are we going to get some headlines later on today? Kriti, there's a lot going on. What's happening with single stocks?
Well, a couple of individual ones to keep an eye on. The banking sector, of course, is always going to catch my eye. A lot happening in Spanish banking. BBVA officially getting the green light and saying they are going to pursue the Sabadell takeover, despite some very high takeover conditions imposed by the Spanish government. Also some news that you are now hearing from various media outlets that both Santander and Barclays are looking to put in bids for TSB. That's the UK subsidiary of Banco Sabadell as well. So we're going to keep a lot of our eyes on what's going on in the banking sector. Sainsbury's as well. So sales rising highly. We'll see how that is interpreted at the open. And of course, JDE Peet's also in focus, Guy.
OK, here we go. Time for Tuesday's session. Let's figure out what is happening. And the answer is probably absolutely nothing. But at least we're going to work our way through the process. It is a step closer to some of the catalysts that we are going to be seeing coming down the pike towards us a little bit later on. As anticipated, nothing from the FTSE. We're up by a staggering 0.1%, actually slightly more than anticipated. The Spanish market doing something similar. I'm trying to sound excited because actually there's not much exciting on the screen right now. But I suspect actually later on today, as we work our way into tomorrow's session as well, there are going to be things that could get this market going. It could be on the fiscal front, or it could be what is happening with trade. There are things that are going to be worth paying attention to. Plus, of course, Francine's panel coming up with the central bankers a little bit later on too. So there are things happening later. They're just not happening right now. So the FTSE is now up by 0.2%. I would argue maybe this is a slightly more positive open than maybe we were anticipating. But it's not that positive. Kriti, sectors.
When we're looking at some of the movers to this side, I'm seeing a little bit of a defensive tilt in these markets. So it is quiet, perhaps, but if you are looking for where the bid actually is, broadly positive. But the outperformers this morning are going to be technology, are going to be healthcare. To me, that screams defensive right off the bat. But take a look at what's lagging. No surprise there. It's the banking sector. Banking consolidation seems very much on the table. Media sector is also dropping as well. You're continuing to see drops across the board. But to me, Guy, from the individual movers' standpoint, SAP, Novartis, Novo Nordisk, Roche, your four biggest contributors this morning. It feels like there's something happening in the healthcare sector, even if it is tiny, tiny moves.
Yeah, precisely. A little bit of a rotation. I think this is all about what is going to be happening in terms of the catalyst later. I think the market is going to wait and see exactly what that is going to look like. Remember, you've got the VIX on the floor right now. You've got markets largely becalmed. Last quarter was turbulent, to say the least. A little pause for breath, maybe as we move on into the next quarter. What are we going to be seeing? I don't know where the catalysts come from. Is it the central banking story? Maybe we're going to see that in Fran's panel a little bit later on. Is it on the trade front? We're counting down to the 8th, 9th in terms of the deadlines there. Does seem as if we still have a significant lack of clarity on that front. Are we going to see the big, beautiful bill getting passed later today, or are we not? And if we don't, what are the implications of that? How does this fight between Elon Musk and Trump develop? And what is happening here in the UK? That's worth paying attention to as well. I think if the bill passes here in the UK later, it's a bit of a non-event. But if it doesn't, then that's quite a big left-hand tail risk, maybe for both the gilt market, the pound, and by extension, maybe some UK stocks as well.
Well, I think it's fascinating. You're drawing the connection between the United States and the UK, both talking about what's happening domestically to try to tackle some of the volatility internationally. Both the UK and the US, Keir Starmer and Donald Trump, trying to balance the books of both countries with, again, infighting from within their own party, as opposed to whether you're looking externally facing. I think that's a really key piece on both sides. But to your point, what does that do to valuations? What does that do to the stock market? We talk a lot about whether U.S. exceptionalism is over. Well, a lot of that surrounds the valuation story. BlackRock's Helen Jewell challenged those conventional assumptions. Take a listen to what she had to say.
25 times the US feels really high. But what's to say that actually people aren't prepared to pay 26, 27 times if they continue to see that growth in that market? Maybe what we have to start thinking about is what is the right multiple that people are prepared to pay for that market? I can see a situation where I can see, assuming we don't have a recession, I can see a situation where I'm sitting here a year from now saying 25 times is a new normal for that US market.
Joining us now, Marina Zavalok, Chief European Equity Strategist over at Morgan Stanley, joining us around the table. Marina, Helen thinks that there could be a situation where in about a year's time, 25 is a new normal in terms of stock valuations for the U.S. market. What is the current normal for European markets right now?
I mean, the European equities market is on about 14 times PE, so well below the U.S. We do think that Europe can go up from there. So we think we can get up to 15 times multiple. We think that the discount versus the U.S. over time can narrow as well, but 25 is very far away for Europe.
But even 15 is historically
it's
high
above average
for Europe. Talk to us about how the valuation standpoint kind of comes into that. And specifically, I mean, my focus has been around the defense sector. We talked about it today with Guy was talking about kind of Keir Starmer and this vote that's coming in. If you have to kind of return some of the funds that have been allocated to defense into welfare costs or vice versa, does that undermine the case for defense that's been driving this market higher?
Yeah, I think for the defense sector, I mean, we're still overweight. It's a long-term story for us. But I think the market at this point, investors are waiting for these long-term earnings upgrades to come through. I don't think there was a lot of optimism around the UK to begin with, but it's really more about Germany, about the Nordics, about Scandinavia, and the rises there. And then within Europe, you have some companies exposed to the German defense spending, which is just huge. It's going to impact broader than just Germany. But what I hear from our analysts is to get the earnings upgrades, especially the longer term earnings upgrades, you need the details around the project awards. And we probably won't get those details until the fall, maybe later this year. So in my opinion, dips in the defense sector will be bought because long only still don't own the sector or have very underweight positioning. But is it going to break out and have the kind of momentum that it had earlier this year? Not for now.
Is Europe cheap, though, at the moment? We're on 14 now. We could get to 15. 15 would be above average. So Europe
It's already above average, actually.
Yeah. So we're not cheap at the moment. What is the attraction of money coming out of the States towards Europe? What is the case right now to be made for moving money out of the States or not allocating as much to the US?
Well, one of the big aspects is just diversification. So I think investors have kind of woken up to the major policy changes, the uncertainties in the US, and thought to themselves, well, if we're allocating to global funds, some of these asset allocators, that's actually 72% US. So is it really diversified? Is it really global? So you see more appetite to invest in international, which is global ex-US. And then you have in Europe, you have what I call the foundations of a bull case being built. So it's not going to impact earnings this year. But in the longer term, you have savings and investment union, you have AI adoption, which is taking off, you have fiscal changes, defense spending, fiscal changes, especially, as I mentioned, in Germany. That will start to have an impact into 2027, 2028. And then lastly, and we could talk about it more, but the euro, I think the euro's strength and the implications it has for constant currency growth comparison to the US is really underappreciated.
Okay, just walk me through that argument a little bit more, because in some ways you could argue that the euro is a tailwind for Europe and for investors, particularly outside the euro area, putting money to work there. But also it's a headwind for European equities as well. A lot of European companies earn money in the United States. That's obviously going to be impacted by this. So I'm wondering what the offset of both of those two factors are.
Yeah, so we just did a really in-depth analysis on FX, and it's amazing to me how differently everybody looks at FX in Europe, because I come from an EM background where you just looked at things in dollar terms. But basically, in general, people look at European earnings growth in local currency. And because Europe is so geographically diversified, only about 40% of revenues actually come from within Europe and the UK in MSCI Europe. We get, as you mentioned, these translational impacts. And so local currency earnings growth, as euro strengthens, just keep coming down. Now it's about 1%. We think it could hit below 0. So optically, it feeds this narrative of Europe has no growth. But in reality, a lot of investors do not hedge FX. And if you're, let's say, a global fund sitting in the US, your fund is in dollars, you should really be looking at European earnings growth in dollar terms. In dollar terms, European earnings growth is now 7.6%. Not 1, it's 7.6% in dollar terms. The S&P XMAG 7 is 6%. So we're above S&P XMAG 7 in dollar terms in our growth, and yet we trade at about a 30% discount. So I think investors are starting to realize that if this strength in the euro is more structural, then actually there are attractions in constant currency to investing in Europe.
How prepared are European corporates for a swing in the other direction? Being short dollar is a very popular trade right now. Being long dollar was a very popular trade, but in the short term, it's a trade that a lot of folks are saying has gone too far when you're looking at a euro dollar of 117 or potentially higher. How prepared are European corporates for a swing in the other direction?
I mean, we've just done this analysis of how corporates hedge, and in general, corporates, they don't really take a directional view. What they do is they hedge primarily their transactional FX mismatches. Transactional, so things like cost revenue mismatches, balance sheet mismatches, things that could really cause a risk to the business. They do not take active calls on translational impacts, which is primarily what you have when you look at, what I was talking about, local currency implications. Most European corporates actually try to match their local-to-local exposure. So what we found is that most of the exposure that Europe has is just translational, and there's not really a way you can be prepared for that. But if things move in the other direction, you'll see local currency earnings go up.
Are European investors, are global investors invested in Europe ready for tariffs? How big a swing factor could this be? And is it possible at this point to make a judgment, do you think?
On whether they go up.
How do I hedge that risk? Should I be hedging that risk? Should I be thinking about that risk? Do I make the decision to invest in Europe after maybe the decision has been made in terms of what the tariff narrative looks like?
Yeah. We've been talking about this for a while, that basically the European tariff risk is far more idiosyncratic than broad-based. So if you look at Europe's overall exposure to the US, it's about a quarter of revenues. So I think initially back in December, there was this perception that entire 25% is going to be dramatically impacted by tariffs. When you break that down, most of it is either services or local to local. So European companies producing goods in the U.S., having manufacturing there, selling into the U.S. The portion that is goods exported to the U.S. from outside is less than 6% of European revenues. Those stocks have already traded down dramatically. And they're just kind of hovering at lows, those highly tariff-exposed stocks. So if we go up on July 9th, if tariffs go up, that pocket of stocks will go down again. But I would say investors are already, pretty underweight those stocks.
If the tariffs are more benign, are better than anticipated, is that the area that I want to go fishing in terms of where the benefit could be?
Well, it seems like 10% is pretty likely to be the baseline. I guess in certain sectoral tariffs, maybe you could get a deal. I'm not that optimistic. But yeah, you could. I mean, there have been some investors that have taken the view that the worst is already in the price for those stocks. Those stocks tend to also have a lot of China exposure.
We're talking about luxury basically here, aren't we?
Luxury is one of the big part. Autos, so we don't like that group of stocks.
Is 10% priced in, though? Like, is it priced in, the stock 600, 100%? What's not priced in, 25?
20% is not priced in. I mean, we have a scenario where, let's say on July 9th, we go back to 20%. Theoretically, that could cause more than 10% downside to the European equities index. But I think given that the market has gotten used to things coming into play and then being taken off, probably investors would not price that 10% downside fully. It would be more like a 3 to 5% downside risk.
I'm going to find out in a few days, maybe. Yeah. We'll see. Marina, great to see you. Thanks very much indeed for stopping by to come and see us. Marina Zavalok, Chief European Equity Strategist, joining us from Morgan Stanley. Let's take a look at the Core 6, figure out what is happening this morning in terms of the centre of gravity here in Europe. This is the picture, as you can see, a very becalmed market. We're looking for catalysts. We're trying to figure out which one of the significant catalysts which are out there right now is going to come towards us next and impact this equity market. But at the moment, you've got some of the pharma stocks on offer. You've got some of the chip stocks on offer as well. LVMH is actually catching a bit of a bid. But net, not a lot of movement this morning. Where else are we watching for some movement? Let's find out with Joe.
So we have got a little move higher in Sainsbury's this morning, Guy, after the quarterly report from the UK supermarket. Now, the numbers actually look pretty much in line with expectations, but potentially not as much of an impact from the discounting that we've seen in that sector recently. So a bit of a relief on that. And the volume's pretty much holding up over at the UK company as well. So that one gaining around 2% in the early trading for Sainsbury's. Then we've got Sodexo. That one was bouncing around in the open of trading in Paris. This is a catering company, of course, but a lot of exposure to the US. Now, it does look like a bit of weakness in the airports business and also offices as well. However, that has already come down a lot recently, that stocks. It's actually recovering a bit, as I say, a little bit volatile in the open of trading for Sodexo, one that's had a bit of a rough run. We're coming back into green territory for now on that one. Then batteries, electric vehicle batteries is the focus over in Belgium today. We've got Umicore, a company that makes a lot of the materials that are used in the complicated process for making electric vehicle batteries. And they've upgraded their guidance after the close of trading yesterday. So getting a decent boost on that stock. One of the best performers we've got on the whole European market today for Umicore. It's only around a 4 billion market cap company, but looking pretty strong in those opening trades. Then we've got another car-related, a good segue, staying in the car space. We've got Renault. This one a little bit lower, however, because they've given a bit of a complex update on their investment in Nissan, saying they might actually do a bit of a loss in terms of an accounting loss, potentially more than 11 billion euros on that was the headline I saw. So Renault actually hit a little bit weak on that one, coming down around 2%. Of course, there is a bit of a CEO change going on over there as well, so a lot of uncertainty on that one today. Then in terms of the share placing, we've got a bonanza. All the share placings keep coming. I think people trying to tap into the rebound in stocks that we've seen in the recent months. So we've got share placings all over the place today. We've got Wise in the UK, probably the most interesting one because this one is being sold down by Peter Thiel, the US billionaire tied to PayPal and Elon Musk. He owns a stake in that. He was an investor in that in the early days, and he's selling a bit of a share in that one. It's coming back to unchanged now at the moment. But also Mediobanca, Impost, Vusion Group, all of them getting decent share sales. Mediobanca actually one of the biggest decliners by points in terms of the index because of those share sales this morning. So that is a big focus for the market. Then finally, to finish on the best performer on the Stock 600, when I stepped away at least, it was Zealand Pharma over in Copenhagen. Now, we have got an upgrade. This is over at Exane. So Zealand makes obesity drugs, but it's not GLP-1s, it's amylin. And I had to really Google and try and actually learn the difference between amylin and GLP-1s before I came on. But this is a suppressant for appetite, essentially, in terms of the reason why that stops people eating too much, and that is gaining because Exane upgraded the stock. I've completely overcomplicated that one. Exane has upgraded Zealand Pharma today because of their exposure to the obesity market, and the stock is gaining at 5% this morning.
All right, Joe Easton from our equities team, we thank you so much. Lots to digest there. Of course, we're going to keep an eye on these markets. Coming up on the program, Bloomberg learns that Apple is considering outsourcing AI for Siri. We're going to bring you our scoop on the topic next. Stick with us. This is Bloomberg.
Welcome back. 20 minutes into the session, and thus far we have very little movement in terms of the indices. As you can see across Europe, we are largely becalmed. Nothing to see here. What comes next, though, could certainly shake things up quite a lot. You've got what's happening stateside, you've got what's happening here in the UK, you've got the tariff story that we need to be factoring into our thinking as well. There's plenty going on. The currency market probably has been more exciting recently, and we continue to monitor what is happening with euro-dollar this morning. But the Euro Stoxx 50 is absolutely unchanged right now. Nothing going on. So let's turn to some of the other stories that we're watching so carefully here at Bloomberg. A scoop coming from Bloomberg. We have learned that Apple is considering using artificial intelligence technology from Anthropic or OpenAI to power a new version of Siri. It's a move which could sideline Apple's own in-house models. This as the company looks to turn around its flailing AI efforts. Peter Ostrom, Bloomberg's executive editor of global technology, joining us around the table this morning. Great story.
Yeah, this is a Bloomberg scoop, and it's very big news. I mean, Apple, of course, is known for its cutting-edge technology. It's done that in smartphones, it's done in music, it's done in computers, too. And now what we're seeing is that with AI, it's fallen behind. And this is really a concession. Big picture, this is a concession that the company is struggling in AI. They're talking with Anthropic, as you said, and OpenAI. They've asked them to come in and see how Siri would run on top of their platforms, the LLMs. And they're running tests. They found out that Anthropic, in fact, has worked out quite well. So this would be a pretty big strategic shift at this point. Yeah. It's very early. I mean, the status here, it's important to emphasize, this is early. They're looking at changes that they want to make next year as they introduce products. They are also still continuing to work on their own AI efforts, and they'd like to be able to use that. They'd like to be able to see how that team can evolve their own internal AI, too.
Is this temporary? Because Microsoft did this. Microsoft, before they invest in their own AI offering, said, you know, we're going to take that stake in OpenAI. We're going to invest in, or at least take advantage of investment or stakes in other companies while we develop our own in-house product. And then ultimately, you were starting to see that shift away from it. Is this Apple's strategy? Take on what Anthropic or whoever has to offer while you also build your own strategy?
Well, Apple hasn't talked about this at all strategically, but you make an important point. They do want to test the best of breed right now internally to see what they can run on their iPhones. They want to see how well it's going to run internally. But I think they are acknowledging now, by letting these companies come in and work with Siri and see what kind of experiments they can run, they're realizing that Anthropic and OpenAI, at least for now, are ahead of them. When they introduced Apple Intelligence, as they called it, they had hoped to be able to do this internally. This is a concession that now they need some outside help to test whether this is going to be
Where's the value in Apple now? If they're relying on others for their AI, which is where everybody sees the value going forward, why is Apple this
Aren't you an Android user?
$1 trillion company? Yeah, we'll park that one for the minute. But where's the value in Apple?
Interest. Well, of course, Apple still has an amazing smartphone business. They also have a very strong ecosystem with the App Store, where they take a cut of all the apps that you're putting onto your phone, everything that you're buying on those apps too. That, of course, is under assault too. There are some people that think they have too much control there. But now they need to move ahead in AI in particular. If you believe that AI is this super important technology that you're going to need to have incorporated in your devices. Apple recognizes that it needs to take a couple of steps forward here.
All right, Bloomberg's Peter Elstrom walking us through those Apple dynamics. We thank you so much. Let's talk about another major heavyweight, of course, in the S&P 500. I think we can call it a tech company. Tesla shares are falling on TradeGate after President Donald Trump lashed out at Elon Musk, accusing the Tesla CEO of benefiting excessively from government electric vehicle subsidies. Now, this comes after Elon Musk slammed the U.S. Senate's latest version of Trump's multi-trillion-dollar tax bill, warning that the cuts to EV and other clean energy credits would be, quote, incredibly destructive to the country. Let's bring in Bloomberg's Global Autos editor, Craig Trudell. What is Elon Musk thinking here? How does Tesla move forward without those subsidies?
So I do think that there's an attempt being made here on the part of Trump to kind of turn this into, he's only criticizing this bill and this budget on the basis of the removal of EV subsidies and how he puts it, the EV mandate. I think Trump, I think to be fair to Musk, his criticism is more than just that, right? He's concerned about, okay, if you're going to do away with these subsidies, with the support, also do away with other subsidies, oil, gas. I think he wants more of a level playing field. And I think he's also very concerned, maybe without saying it so explicitly, that he invested all of this capital, this, sort of political capital on this Doge project, has spent all this effort and time and, sort of sacrificed his reputation only for the Republicans to come in and introduce, this bill that adds to the deficit so significantly. So, I do think that there's a real concern here. We talk a lot about tax credits for consumers. I think the other sort of underappreciated aspect here is also, the doing away with California's mandates for electric vehicles, the doing away of fuel economy and emission standards. All of these things will combine to hurt Tesla pretty significantly and have been, real sort of tailwinds for them in the past, few years.
Just in a few seconds, what's your latest take on the tariff story? It looks like the EU is prepared to accept a 10% baseline tariff as long as it gets carve-outs for cars. Is that going to happen? Is that something that we should expect to happen? Because the EU doesn't sound quite so convinced on this.
Yeah, I think there's a real concern that Trump is going to budge on this, because when you talk with him about trade and about tariffs, this is the sector that he goes to immediately, right? And so I do think that the European car industry is going to have a really hard time, to the extent that there are some sector carve-outs, that they get in on that action.
It's interesting, the Japanese are looking for the same thing. You do wonder whether Trump is going to budge on this. Craig, thank you very much indeed. Craig Trudell, Bloomberg's Global Autos editor, joining us on, many aspects of this sector right now in play. Coming up, we'll discuss the risks to the global economy. So many risks right now. The market is watching all of them very, very carefully. Freya Beamish, chief economist at TS Lombard, is going to be joining us next. We will discuss what is happening stateside, what is happening here in Europe, what the trade story looks like, what the fiscal story looks like. All of that coming up with Freya. That's next. This is Bloomberg.
This is the opening trade. Welcome back. About 30 minutes into today's session. Not seeing a ton of movement on these indexes. Guys, we really talk about this idea of what the next catalyst is. Is it trade? Is it the budget vote when it comes to here in the UK? Or is it ultimately monetary policy, Sintra? Lots going on there.
They're all the same catalysts, but they're kind of morphing a little bit.
Whose voice matters the most?
And we're going to, you're wondering where they're going to crystallize. So let's talk about what's happening stateside. We'll talk more about the UK maybe in just a moment. Senate Republican leaders are struggling to gather enough votes to pass Donald Trump's $3.3 trillion tax and spending bill. Speaking to Bloomberg, US Treasury Secretary Scott Bessent, who has been heavily involved, of course, in the negotiations, said he is optimistic that the Senate will pass the bill in relatively short order.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like.
Okay, how does the market react to this? Because there's some big numbers involved here, particularly when it comes to the deficit. And that's where Valerie Teitel steps in.
Yeah, $3.3 trillion. That was the latest CBO estimate of how much the Senate bill can add to the deficit. Now, Guy, this is substantially more than the House version of the bill, which was around $2.8 trillion. The question on my mind is when that House bill price tag came a few months ago, there was a big puke in the long end of the Treasury market. 30-year yields were breaching 5.15. Why isn't there the same reaction this time around to a bigger price tag from the Senate bill? We are, substantially lower in the 30-year yield, not at 5.15, but at 4.75. To me, this is the market saying that the U.S. government is dealing with the debt problem, not by cutting spending, but by pressuring the bank to cut interest rates, pressuring Powell to cut interest rates. And the Treasury market is seeming to read that as one and the same. It's also pressuring the dollar lower. We hit a fresh year-to-date low for the U.S. dollar yet again overnight. And now year-to-date, in the last 6 months of the year, the Bloomberg Dollar Spot Index is down some 11%. Its worst start to the year in over 50 years, Guy.
Valerie, thank you very much indeed. Joining us around the table to carry on the conversation, Freya Beamish, Chief Economist at TS Lombard. How are you viewing what is happening in the States right now?
Even the House bill was already sort of problematic on a kind of a 12 to 18-month time horizon. We think probably that yields will get up to that 4% mark over the course of next year. But the Senate bill, as was just said, sort of expands on some of that, on some of the more kind of, the expansionary side of it is just a little bit more in your face with the Senate bill. What I don't like about any of this is that the liability that the government is trying to issue here, they're trying to issue more of it, and in the composition of these bills is a deterioration of the quality of that asset, particularly as a hedge for equities, because a lot of the spending is being done on deterioration of the supply side through deportations, which is a real significant shift from that sort of improvement in supply side conditions that we've seen over the past kind of since over the course of the global financial crisis and over the course of hyperglobalization. These were all kind of slow burn demographic dividends being added to the U.S. economy, and now we're seeing the reversal of that with lower immigration and greater deportation, and that's really a very important shift that we're seeing here. So we've got two shifts happening. One is that there's a pro-cyclical element to this, and the second is that there's an element to this which is deteriorating the labour supply of the U.S. economy, and those two things can fundamentally shift the correlations within the macroeconomy and to the market.
Stagflation?
It's stagflationary at the margin, so I have to be careful not to be too doom and gloom. I do think I do think that real yields will be better than in the 2010s. I do think that real growth will be better in the 2010s. I do think that inflation will be higher than in the 2010s, so perhaps not so great for the bond space, but some of that improvement, that increase in inflation will be a demand-led story, so there'll be some positive story coming out of that for equities, talking big picture here. But in terms of the House reconciliation bill and then how it's coming through the Senate, the shifts here, you're not really getting that much in terms of positive impulse from growth. We're talking about big tax cuts for people that already have a lot of income there, so low marginal propensity to consume, so not a great multiplier on the tax cut side. And then on the spending cut side, there is a strong multiplier there, so that's a bigger drag. And then how are we offsetting this expansion of the deficit in the first year? Well, there's a tariff revenue there, which is a negative supply shock again. I'm very kind of hyperfixated on negative supply shocks because they deteriorate the hedging quality of bonds for equities. So the spending that is coming through is about reducing the supply side capacity of the economy. Bad for bonds and bad for equities at the same time. Term premium should be higher. And the revenues that are supposed to be offsetting this expansion of the deficit are also negative supply shocks, which is tariffs.
So you talk about the Marshall, what an economics lesson right there.
Wow.
We need like a flow chart. But you talk about the marginal propensity to spend from some of these moves. Let's talk about the marginal propensity to save here, because I think what we're waiting for is for some of the data to actually show a hit, and it hasn't yet. Is that because Americans are saving more? That's unusual.
Yeah. No, I think you've hit the nail on the head as to why this is not actually coming through at this moment in time. the difference between the House reconciliation bill reaction to that and what's being done in the Senate at the moment is the data just do look a bit softer. The hard data coming through on the consumer just do that. Those data do look a bit softer, and so there's a little bit of this is all happening under the guise of will the Fed be able to cut rates? Is the economy deteriorating? Is there a greater sort of propensity towards saving as a result of the greater uncertainty that's being exacted upon the U.S. economy? So they're almost kind of creating savers for the expansion of the deficit and mopping that up on either side of the flow of funds there.
Yeah.
But the bigger picture is we haven't seen the inflation data, the tariffs coming through in the inflation data yet. And that's likely to come through in the second half of the year. So, yeah.
Well, speaking of Freya, it keeps coming back to the tariff story. Torsten Slok, this was on a couple weeks ago, June 21st, put out this piece on his blog. And if you'll indulge me, I just want to read out a piece of this to you. He says, maybe the strategy is to maintain 30% tariffs on China, 10% tariffs on all the other countries, and then give all countries 12 months to lower non-tariff barriers. This would seem like a victory for the world, and yet would produce $400 billion of annual revenue for taxpayers. Maybe the administration has outsmarted us all. Does that math work, Freya? If we talk about 10% tariffs on the rest of the world, which is looking likely, by the way, when it comes to the European perspective, is $400 billion of annual revenue enough?
Maybe in the first year, so that those numbers add up to probably about 0.6% of GDP. In the House reconciliation bill, you've got tax cuts that are about 0.8% of GDP, and then spending cuts take about 0.2 off of that, and it's no coincidence that those both add up to an expansion of 0.8 and a contraction of 0.8, and so it actually probably evens out in the first year. That coincidence is there because those numbers need to add up to square the politics in the Congress between those that are up for re-election in the midterms and those that are more fiscally conservative. But it's a bit of a charade because the tariff revenues are just not going to stick. If those numbers are in the system, then imports probably will start to decline, and so your tariff revenues are going to decline as well. It's not like smoking.
Freya, I want to bring this back to your comments about the labor market. I was reading a note from Bruce Kasman at J.P. Morgan, who actually sees that the U.S. economy is going to slow, but the unemployment rate isn't going to rise because of what you just mentioned about immigration keeping the labor supply tight. How do you see that situation playing out? Because in that situation, I mean, the Fed really can't ease if they don't see this labor market weakening.
It's really hard for me to understand how there can be like a nice type of a cut in September. Like either the inflation is going to come through and the labour market doesn't crack, in which case they're not going to cut, so that's not great. Or the inflation comes through and the labour market cracks, and that's even worse because that's sort of stagflationary. You don't know where to go, bonds versus equities. Or the inflation doesn't come through, and I think what people aren't understanding is that the tariffs are in the system. We know that in the data. The tariffs are there. China's not paying them. We know that from the PPI data and the import price data. So that means if the tariffs don't come through in CPI, it's because the US consumer has actually finally cracked, and the labour market will follow.
Yeah, there was some discussion previously about, the fact that services inflation makes up 65% of CPI. Yeah. So goods inflation, it can really be dwarfed by moves in services inflation, which could be caused by a weakening consumer. So that's something that you could definitely see play out?
Yeah, I think in the first instance, you'd probably get a bit of pass-through from tariffs to services inflation as well. So maybe the PCE gets to above 3% year-on-year by Q4, but it'll probably reverse very quickly as well. All of this provides quite a lot of trading opportunities because as a macro investor, what we're really talking about is the debate, not my kind of like pontification as to whether tariffs in 3 years' time will actually leave US inflation higher. It's sort of what's going to be validated in the next 6 months or so. And I think probably the inflation data will start to come through and show that the tariffs, probably also in services initially, but that will also undermine the real spending power as we go into next year.
Fred, before we let you go, Rachel Reeves, how's she going to balance the books?
Ooh, I like to reframe it slightly because I think we're so sort of focused on this fiscal headroom, and she's given herself a little bit more fiscal headroom. But honestly, like if she at the moment it's front loaded, right? The budget is front loaded. We've already on an OECD comparison, we've already got a very large fiscal drag as compared with other countries. And then we do have a general election in a few years' time. And if we're myopically focused on balancing the books in over this period, we know who's going to come in the next general election, and then what's going to happen to the debt ratio. So it's almost like we need to sort of. I hope that wasn't too elliptical, but there is a sort of a.
But your point is, don't worry about balancing the books.
Well, the point is that
is the bond market going to be okay with that?
Maybe not in the first instance, because there is a strong correlation in the UK between bond issuance and the detrended movement in yields. The reason why I focused on emphasised detrended there is because in the longer term data, there's actually a negative correlation between the change in the debt ratio and the change in yields. That means debt ratio goes up, yields go down, because in most of the time, it's actually the private sector that is more important for driving yields. And there's a flow of funds identity which suggests that private sector surplus increases and the deficit increases at the same time. When does the private sector surplus increase? It's when the private sector is weak, and therefore growth and inflation are declining, and so yields should be declining as the deficit is rising. That's the correlation that is in the data since the 1950s. The only exceptions to that are when you have negative supply shocks. So 1973, 1979 and 2022. So big negative supply shocks switch the correlation between debt issuance and yields. And so spending to protect the supply side is actually the smart thing to do.
All right. Freya Beamish, Chief Economist at TS Lombard, talking about the math on both sides of the Atlantic. We thank you so much. Coming up on the program, we're going to speak to the CEO of Renk, the German tank supplier set to play a key role in Europe's push to rearm. That exclusive interview coming up next. Stick with us. This is Bloomberg.
Probably a moment to talk about the European defence sector, a sector that is firmly in focus right now, and a number of companies are at the heart of this story, one of which is the German gearbox maker Renk. It makes gearboxes for armoured personnel carriers, tanks, this kind of kit. And it's out with a note saying that the Bundeswehr, the German army, will need up to 1,000 new wheeled tanks and as many as 600 MBTs, main battle tanks, by 2035. It follows an announcement of a 5% defence spending commitment by NATO members at the recent summit in The Hague. Renk says it plans to invest close to 500 million. Let's get some more details from Ollie Crook.
Yeah, that's right, Guy. I mean, listen, all the talk of last week was the big, beautiful number, the announcement that we got from NATO, the 5% defense spending that everybody had been anticipating. It is what has prompted billions and billions of dollars to flow into these defense companies. We've seen record high after record high. The problem is that now it's the hard part, right? It's actually executing on this stuff. There was a note from Goldman Sachs that actually summarizes quite nicely that in the period from 2006 to 2020, if NATO had hit its 2% target, that would have meant 1.1 trillion euros more investment in this industry. The fact that you didn't get that is the consequence of what we're dealing with today, which is you lack the scale in Europe, you lack the capabilities, you have massive gaps on that, and now it's up to these companies to basically execute on this. Renk is one of them, as you mentioned, Guy. You know, they make the guts of the tanks, the transmissions, the suspensions. They're in the Leopard tank, they're in the Leclerc in France, they're in the Challenger of the UK, the Bradley in the United States. And so we're very pleased to be joined now by the CEO of Renk, Alexander Sagel from Frankfurt, to discuss a little bit about the execution. I'd like to start, Mr. Sagel, if we can, just on what we got from NATO last week and what your reaction there to the spending commitments are, and your sort of baseline assumption before we got these formal commitments with annual growth of about 10%. Does that now change?
Yeah, good morning. I think last week's decisions on the NATO summit in Den Haag were, from my point of view, truly groundbreaking and milestone setting, and clearly giving us, from the defense industry side, a clear mandate to improve and to boost European and NATO's defense capabilities. If I just look on Renk, which is my first duty, of course, I can only say that from Renk point of view, we are ready to deliver, we are prepared, and we are also ready to invest further in order to support the ramp up of the needed capabilities.
And in terms of ramping up, one of the big constraints for many of the European companies has been capabilities. There have been some announcements that you have made that you can actually boost some of your capabilities in your existing facilities by 50%. Well, you have to expand those further. What does your footprint look like going forward?
It's a very important question, and I'm happy to answer. We have a well-invested industrial base currently at Renk. On top of this, we have a clear plan how to scale up by using our European footprint, by increasing, for example, shift models, and by a constant annual investment into capacity in the range of 3%. On top of this, it's very important to have the supply base under control, and here we are really taking care in order to keep this control, to support our suppliers, and even to build up carefully some needed inventory in order to be ready to produce in the next years when the new contracts from the 3.5% GDP spending is finally coming.
Alexander, good morning. It's Guy. Where are the bottlenecks right now? Where are the challenges? Is it in terms of the supply chain? Is it in terms of staffing, labour that you're finding issues with? Where are the issues that you need to focus on, and how quickly can they be resolved?
Our strongest focus is clearly on the supply chain. Happily, Renk and our products, we are not so much dependent on electronics, on chips, etc., etc. We are not so much depending, not at all, to be honest, on rare earth metals. So the clear focus is to make a health check on our supply chain, to support our suppliers in order to build up the needed capabilities. And on the other side, of course, it's important because we are growing, we need to have people. But so far, we had not a problem to find the appropriate personnel in Germany.
Is it an offset? I keep hearing this argument. As the auto sector struggles, the defence sector grows. How easy is it to train somebody coming out of the auto sector, building a gearbox for a truck or a car, which don't have gearboxes anymore, certainly in the EV world, and transfer that skill into building a gearbox for a armoured personnel carrier or a tank?
I think there's a certain source coming from automotive industry of capable workers, but I think it's fair to say that at least from the Renk point of view, we are not having these high demands. I mean, for example, if you just talk, for example, about a headcount increase during the last 12 months, 18 months, we increased our headcount in our lead plant in Germany by 10 to 12%. So we have a moderate increase because at the same time we are realizing production efficiencies. So of course, I mean, if it comes to specific technological requirements, if we talk about digitalization, hybridization, we are looking for sure in the automotive sector to get experts out of this, but at least from the Renk point of view, we are, if you want to call it, too small to absorb that massive demand from other sectors like for automotive or steel, for example. But to train a person to assemble automotive transmission, to assemble in the future tank transmission should be not a problem. It's a question about the demand and the absorption rate if you look at Renk.
Alexander, it's Kriti in London. If I could just take a massive step back here, one of the big conversations we're having, at least on today's show, has been the question of how sustainable the promises around defense spending actually are. There's a big vote happening here in the UK at the moment that has to deal with some of the allocation of those resources. It's also the bear case, by the way, in terms of the European equity market. From your perspective, what is the biggest risk to getting that defense spending that's been promised to the actual inner workings of a company like yours?
Very good point. I think it depends pretty much on the financial capabilities, on the debt exposure of the different nations. If you take, for example, Germany, I'm very convinced, and there's a clear commitment from the German government to spend in the next 5 years in the range of 160, 170 billion in defense, and to ramp up to 3.5% spending in the year 2029. I think that some other countries, if you go to France, if you go to Italy, for example, will have a longer lead time in order to reach this level. And they need some support, for example, from the European Union to build up a kind of European defense bank. I think alone it's not possible.
And looking at the future of sort of tank building within Europe, I mean, this is the off-sided statistic that I mentioned. It was mentioned in the Draghi report and by many others that the Europeans make basically 12 battle tanks. The U.S. makes 1. Where do you see that going? Are we going to see consolidation in terms of the kind of hardware that is being produced? And what does it mean in terms of, for Renk, in terms of sort of how you're going to cater to those things? Is it going to be just one battle tank within Europe?
Very important question. I mean, if I could just start by Renk and to explain the Renk situation. If you take the European transmission market for tracked vehicles or for armored platform, it's quite consolidated and Renk is clearly the leader. But you're absolutely right. If you look on main battle tanks, if you look on armored personnel carrier, we have a lot of different types of platforms in Europe. So from my point of view, it's mandatory and it's absolutely important to have a consolidation. However, I do not believe that politics are the main driver for this consolidation. The consolidation must come from the industry, and if you look back during the last 1, 2, 3 years, I think there are some good examples, but it must be driven more and we must be faster, because at the very end consolidation is needed in order to improve overall competitiveness of the European defense industry.
And also just sort of looking at your stock performance, obviously it's up about 250% since the IPO, about down 20% in basically the last month. There's a fairly large short position that's been put out. How are you dealing with the sort of volatility and the fluctuations of valuation? Would it be easier for you to have sort of larger sort of anchor investors? How are you dealing with that challenge?
I mean, first of all, the market price or the share price is determined by the market. All what we can do from Renk's side is provide performance on our financial KPIs and performance to our customers. Generally speaking, of course, we have a business model as being an independent global supplier of mission-critical drive systems. So we welcome, of course, every kind of shareholder who is supporting this independent, profitable and growing business.
Alexander, we're going to leave it there. Thanks for taking the time to stop by and see us this morning. We really appreciate it. Come back anytime. Alexander Sagel, the CEO of Renk. And, of course, our thanks to Oliver Crook. The debate today, this is a story that sits at the heart, you could argue, of some of the debate that we're going to be having around Europe as well this morning. Yeah. And in the United States. Where do spending priorities go? Where should they go? There's a guns or busts kind of debate that's happening here in Europe. But it was also interesting listening to Freya Beamish a little bit earlier on talk about the idea that actually in some ways governments can't put fiscal drag into the system at this stage, because there's a danger that actually growth slows and actually you end up with a slower growth trajectory, which therefore impacts your debt sustainability story. So there's a kind of argument that says spend, spend, spend. Yeah. And that's the debate we're going to be having in Washington so much a little bit later on.
But the problem here ultimately is that if you do that, at what point do the markets kind of whip you back into shape? And that's something we've seen under the Trump administration. It's also something that monetary policy officials in Sintra are paying attention to. At 2:30 p.m. London time, Francine Lacqua is hosting a policy panel with the world's top central bankers. Stick with us. This is Bloomberg.